Hi, I'm John Mark Young, President and Chief Investment Officer of Whitaker-Myers Wealth Managers, and I'd like to welcome you to another installment of the Whitaker-Myers Wealth Managers What We Learned in the Markets This Week video. Remember, our aim is to provide you, our valued clients, with a brief video giving you information that is helpful to your understanding of the markets from a biblical worldview with no financial agenda, which of course makes us uniquely different from the news media in America. This video is for informational purposes only and should not be relied upon to make investment decisions. The clients of Whitaker-Myers Wealth Managers may maintain positions in the securities discussed in today's videos, and all opinions discussed are solely those of John Mark Young and not those of Whitaker-Myers Wealth Managers. So let's talk about the four things we learned in the markets this week, starting with point number one. And point number one was it was actually a nice bounce back week for the markets this week, except for the antiquated Dow Jones Industrial, which was down for the week. Now, some of you might say, why do you call that antiquated? Why do you not like the Dow Jones Industrial? Well, two basic reasons. I'll go on a quick aside here. It's not as broad-based and destructive to the markets as the S&P 500 is. And second, it was partly created by Edward Jones, which they are now one of the slimiest and worst financial firms in the industry in regards to the kickbacks and revenue sharing that they receive to your great expense if you're one of their clients. Or any of their clients. It's awful. I can show you right on their website how much money they make. It's awful. But alas, that's not why you're here. I'm not here to bash on them, even though I did. So let's talk about what happened in the markets this week. First, let's look at some stocks that made the news this week. Many for good reasons and some for a bad reason. But one that was for a very good reason was NVIDIA. NVIDIA's earnings came out this week, and that's what the market has been waiting for since last quarter when they released their earnings. NVIDIA absolutely crushed it. They crushed their earnings thanks to AI growth, which we all know is happening like crazy right now. They came in with adjusted earnings of $2.70 a share, and they were only expected to make $2.09 a share. On the other side of the equation, somebody like Dick's Sporting Goods reported this week, and they reported a profit drop and had to cut their earnings outlook because of an uptick in retail theft, especially in Democratic-ran states where the district attorneys are refusing to prosecute theft under a certain amount. Now, here's where politics plays into economics, folks. If you work for Dick's Sporting Goods and you got a pink slip because of poor earnings as a result of all this theft, you're not happy. If your Dick's Sporting Goods got shut down because of all this theft, you're not happy. Something that needs to be fixed for the benefit of the good people in the communities. By the way, that was the first time ever Dick's Sporting Goods talked about shrink, which is the retail industry's verbiage of theft, in a press release in their history. Macy's also reported earnings, and they said they expect lower sales because people are spending more on experiences than products. And when they do spend on products, they become pickier and more price-driven, which is why you've seen a good run in TJ Maxx and Ross stores this year. Rite Aid plunged about 50% after the Wall Street Journal reported the drug chain is prepping to file for Chapter 11 bankruptcy. So probably going to see your Rite Aid, if you have one in your community, going belly up. And then there was Hawaiian Electric, a very nice utility that you would think is a safe dividend-paying stock. They dropped 50% after Maui County sued the utility for fires on the Hawaiian island. It's why mutual funds are a much safer option, in our opinion, because even a safe stock like a utility can have something like this, or maybe a political scandal like the Ohio-based First Energy had, that'll just rip their stock apart. Finally, each week, we track the Atlanta Fed's GDP Now model to see if the expectations for our economy and the economy's growth is improving or declining. I honestly didn't think it was possible, but friends, this number actually jumped this week from 5.8 to 5.9 after reading releases from the U.S. Census Bureau and the National Association of Realtors, something I'll talk about here in a second. So GDP seems to be heading, at least at this point, for a very strong quarter, something we'll continue to watch week by week, which you need to watch on this report. Additionally, we track the initial claims for unemployment insurance each week to see if they're starting to become breaks in the labor market because people are getting laid off and thus having to apply for unemployment insurance. If I can't find a job after I get laid off, I need unemployment insurance. This week, they came right in at 230,000, not bad at all, as you can see from a year-to-date perspective. And finally, let's look at the markets. The S&P 500, which is our proxy for growth and growth in income, but only when taken together, that was positive 0.82% this week. The Russell 2000, which tracks our smaller and mid-sized companies, or aggressive growth in our Dave Ramsey vernacular, that was down 0.35%. And finally, the MSCI EAFE, which tracks international stocks, they ended the week up 0.56. So the S&P 500 wins the prize this week, my friends. Point number two, the housing market might be frozen, at least a bit, but what's this National Association of Realtors info that came out this week? Improving GDP by 0.1%. That had to be good, right? Well, it was new home single families sold, new home builds. And those are booming, relatively speaking. New home sales are up about a third from a year ago, and they came in at 714,000 on an annualized number, meaning that if we keep at this pace, we're going to hit 714,000 new homes being built and sold this year. That's a 4.4% increase from last month and a 31% increase from last year. And this is in the midst of prices for existing homes rising to record levels and interest rates now topping 7.3% on a 30-year mortgage. So why the boom in new home builds? Well, just as we said a few weeks ago, the National Association of Home Builders will tell you there are just 1.1 million homes for sale right now in July, and that's less than half the average that are normally available for sale between 1990 and the start of the pandemic. So if you can wait to buy a home, now is not the time to be buying a home. Let the market recover in terms of supply. Perhaps do what most people are doing. Pursue a new home option. Keep our home builders building. We're nearly 3 million homes short in the U.S. right now, so all this building is actually a good thing. And maybe this is actually what the Federal Reserve wanted: raise interest rates so high, keep people in their homes so they don't refi, they don't want to leave, but get homes building. Get homes building to get us caught up on what we need to catch up on in terms of our homes. Not what your realtor wants, but we like it. Point number 3, this week was the Jackson Hole Economic Symposium, and it gets a lot of news coverage, as it always does, but maybe even more so this year because of the impact the Federal Reserve is having on our economy. Now, you might be asking, what is the Jackson Hole meeting anyway? Well, let me give you a quick primer on it. It's put on by the Kansas City Federal Reserve, and they've been doing that since 1978. It's been held in Wyoming since 1981. And here we got world leaders gathering to discuss important and current policy matters in regards to the economy. Each year there is a theme that papers and research are done around the topic and then presented at the conference. This year's theme was structural shifts in the global economy, and speakers were our own Federal Reserve President Jerome Powell, Christine Lagarde, President of the European Central Bank, and let's see if I get this right, Kazuo Uda, Governor of the Bank of Japan. All those topics and speakers are great, and those are things you can go read. They're published right now, but the real impact for the U.S. markets was what Federal President Jerome Powell said during his speech in interaction with a few of the reporters and that are allowed at the event. Thankfully, he sounded as if this rapid race increase that we've been dealing with is on pause for now. And as he spoke, the CME Group, who tracks expected interest rate movements by the Fed, we saw their probability of a rate increase at the September meeting drop to only 20%. However, he did say that if the economy remains resilient, and thus our inflation numbers, which have been dropping, but start to stall, meaning they drop but don't come down to where they need them to that 2% target, then they'll be forced to move again. So the Fed futures for November and or December jump to a 50% probability for an increase. So essentially we learned this: probably nothing happening at the September meeting, and a 50-50 chance something will happen at the November or December meeting, all data dependent, which is why you should watch this video series. Point number 4, we are finally going to get an IPO next month. Finally, an IPO, initial public offering, a new stock on the stock market. Next month, San Francisco-based Instacart, who goes by the name Maple Bear, will be listed. Instacart is the largest grocery delivery business by sales, and what we learned this week as they published documents Friday with the SEC ahead of their listing was that they now have revenue of $1.5 billion for the first 6 months of this year, 2023, which is 31% higher than a year ago. And that $1.5 billion turned into a $242 million profit after all the expenses that they had to pay, which is better than a year ago when they actually lost $74 million. That's not uncommon, though, for a startup to actually lose money in their early growth stages. There's no exact date for their IPO, but it should be coming in the next few weeks, probably September. And what Instacart does, if you don't know, is they send out couriers to your favorite grocery store to pick out your groceries and then deliver them to your home. Now, because Amazon owns Whole Foods, other grocers like Kroger, Giant Eagle, they have been drawn to Instacart as a way to compete with the giant that is Amazon. There are about 7.7 million active users on Instacart, and they spend on average $317 a month. Maybe some of you are actually part of those users. Now, this is a great company for 2 different reasons, in my opinion. If you're in baby steps 1, 2, or 3, and you need a side gig to hustle your way out of debt quicker than if otherwise, this is an option. Become a courier for Instacart. Additionally, if you're killing it in baby steps 4, 5, and 6, or you're in baby step 7, Technology has now made a way for your busy life to get a little less crazy while you help someone else earn some dough by shopping for you in the grocery store, places that are very repetitive, that add no value to your life for you to go to the grocery store. They just take your time. You can afford it. Now you can pay somebody else for doing that. Isn't America great? It sure is, and I sure do believe it is. Think about this. This is a new technology. The new technology's job is to make your life easier. But your life, you could be on different ends of the spectrum. What if I'm on baby steps 4, 5, 6, or 7, killing it? Well, this has now made your life easier. You get to spend more time with your family. If your job's stressing you out, you need to spend more time with your job. Now you don't got to deal with the grocery purchase. Save that cart every week so that it just gets rebought every week if you use the same amount of groceries. I can get access to fresher foods. I don't have to go to Burger King or McDonald's so much. Don't have to eat that nasty food. And if I'm in baby steps 1, 2, and 3, I probably can't afford this. I probably shouldn't pay for this. I probably should do my own grocery. But now I can actually be paid to do it for other people, which again expedites my baby steps 1, 2, and 3. If I'm motivated, focused, if I know the principles that are going to help me get out of debt quicker, that I can learn through Financial Peace University, or I can learn by listening to the Ramsey Show. These are all great things. Technology made life better for everyone in this case, as it normally does. And that's the beauty of capitalism. That's the beauty of a free market. That's the beauty of letting somebody go invent something and making the government stay out of their way. People make profits because they help people, not because their ulterior motive is just to get rich. Sure, they do get rich. But you only get rich if you add value. As Dave Ramsey always says, people don't get rich by stealing, cheating, or lying, because you know what happens with them? They eventually get caught. In our industry, Bernie Madoff, yeah, he hung around for a while. Now he's sitting in probably Hades, but he was in jail till he passed away there. And so all that to say, what a great technology. What a great country we live in. Ain't America great? Thank you so much if you've served our country. So if you enjoyed the 4 things we learned in the markets this week, would you do us a favor? You can do us a favor by hitting the like button. The like button helps with Google and YouTube's algorithms, because the more people that watch this video and then hit like, Google and YouTube says, hey, this is good content. We're going to push it out to more people. The people that watch it and don't hit like, it actually hurts us. So would you do a favor? Hit that like button, as well as you can hit the subscribe button. And the subscribe button makes sure that when our content comes out, it comes out to you first. You get to see it first, watch it first, and be one of the first to comment or like. As well as if you'd like to meet with somebody in one of our financial coaches, maybe because you're in baby steps 1, 2, or 3. Imagine that, a financial advisor that says, if you don't have money to invest, we're okay working with you, because we have Ramsey Solutions financial coaches on staff who will help you get out of debt, stay out of debt, live debt free. As well as if you're in baby steps 4, 5, and 6, you can hit that same link and meet with one of our financial planners, and they would love to help you execute your baby step 4, save for college, as well as work out a plan to get your mortgage paid off so you can eventually get to baby step 7, where we all get to live and most importantly, give like no one else. Thanks so much. We'll look forward to seeing you next week.